The yen bounces hard after slumping through 160. Some traders think Japan's authorities intervened, but there's no official confirmation. ANZ Research has changed its expectation for Fed rate cuts this year to 2 from 4. And New Zealand jobs data tomorrow is expected to show disinflationary support for the Reserve Bank. That's coming up in our 5 Things in 5 minutes. And then in part 2 of our bonus deep dive interview, ANZ Head of Australian Economics, Boyton, says if Stage 3 tax cuts don't trigger a lift in consumer confidence, all eyes will be on the RBA.
If we get through July and August and into September and consumer confidence is still stubbornly stuck at the sorts of levels it's at right now, we're probably not going to get that lift in GDP growth. The economy will be weaker. There'll be a bit more downward pressure on inflation.
But first, in 5 and 5 with ANZ, the US dollar and US Treasury yields are down this morning after the dollar's sharp reversal last night against the yen, possibly on intervention from Japanese authorities. The US 10-year Treasury yield was down 5 basis points to 4.62%, and the 2-year down 3 at 4.97%. That saw the US dollar slide against most currencies, but mostly against the yen. More on that shortly. But as of 5 a.m. Sydney-Melbourne time, the Aussie and Kiwi dollars are up about 0.5% at 65.67 US cents and 59.78 US cents respectively. Meanwhile, ANZ Research has changed its call for Fed rate cuts this year from 4 25 basis point cuts to 2, with 1 each in the third and fourth quarters. Here's ANZ Head of G3 Economics, Brian Martin.
We had thought that the inflation data in the US had scope to strengthen in January and February, mainly because the PCE deflator data was so weak in the latter stages of 2023. However, we had limited tolerance for that, and the PCE data at 0.3% on core in March are just that little bit too high, we think, for the FOMC to have the confidence to proceed with rate cuts in the manner that we had anticipated they might do a month or so ago. And on that basis, we have scaled back our expectations for the magnitude of rate cuts this year.
Number 2, there was a sharp rebound in the yen late yesterday after the US dollar slipped through 160, leading to speculation the Japanese authorities intervened to support their currency. In holiday trading, the yen had its weakest level since 1990, but quickly rebounded to 155 per dollar. ANZ FX analyst Felix Ryan says the sharp correction could just be down to thin liquidity yesterday.
From 2010 onwards, really, the average, I suppose, absolute move in the dollar yen in response to intervention by authorities is about 3%. It's what we've seen at the maximum point today. Dollar yen was down 2%, and when I last looked, it was only down less than 1%. So if it was intervention, it certainly doesn't speak to it being the most significant intervention that we've seen.
Number 3, Felix says if authorities did intervene, the ongoing difference in economic fundamentals between Japan and the United States mean any effect won't last long.
Really, if there is intervention from Japanese authorities, while that might provide some intraday relief for the yen, and certainly that is what has happened historically, without any change in the economic backdrop, so Fed rate expectations, Japanese economic data and US economic data, then the benefits from intervention for the yen will be fleeting.
Number 4, New Zealand first quarter jobs data on Wednesday is expected to show the labour market continuing to move into disinflationary territory. ANZ economist Henry Russell is expecting the unemployment rate to rise from 4% to 4.2%.
The labour market is evolving broadly as the Reserve Bank expects currently, and all forward-looking indicators point to a pretty rapid deterioration over the year ahead. From an inflation perspective, that certainly bodes well, and we are expecting to see a further moderation in inflation moving forward as a result of the loosening in the labour market. But certainly it does present plenty of challenges for households as the labour market deteriorates and unemployment moves higher.
Number 5, Henry says while unemployment looks set to rise, employment growth is expected to remain strong, up 0.3% in the March quarter, as the effects of previous stimulatory fiscal policy show through.
the growth in employment is coming from sectors that are very likely influenced by fiscal policy, sectors like healthcare, public administration and safety, and education and training. There's clearly a catch-up occurring as we've moved past the intense shortages we saw through the pandemic years. Businesses are still returning employment levels to a more normal setting, but that appears to have largely run its course, and we do expect to see a fairly decent moderation in labour demand across the year ahead.
Henry Russell there. Now, in today's bonus deep dive interview, ANZ Head of Australian Economics Adam Boyton looks at how the RBA might be forced to react if Australia's Stage 3 tax cuts don't shift the dial for consumer confidence, which are currently stuck at 1990s recession-level lows. So, Adam, what if those tax cuts don't lift consumer confidence? Is it basically over to the RBA to move sooner?
If, for example, we don't get any recovery in consumer confidence as a result of the tax cuts, that says a couple of things to me. The first thing it says is that pickup that I'm expecting in consumer spending in the second half of this year might not come through. And if I don't get that pickup in consumer spending in the second half of the year, it also then increases the risk that we don't get a pickup in GDP growth in the second half of the year. So if that was to be the case, firstly, I think it tells you something really important about the economy. And if we don't get that lift in consumer sentiment, it tells you that economic growth may not pick up in the second half of the year as we expect. And the really important thing about consumer confidence or consumer sentiment is we get it so much more regularly. Also, it's a really timely indicator. And what I mean by that is the GDP data that encompass the tax cut, we won't actually get that bit of economic data from the Bureau of Statistics until early December. But we get out of the ANZ Roy Morgan Consumer Confidence Survey a weekly guide to consumer confidence. And so the other importance of these sort of sentiment confidence measures is they can be much more timely than the official data from the Bureau of Statistics.
And just looking at this research you've done, are you factoring it into your GDP or consumer spending models any differently after doing the research?
What it's going to give me is potentially a bit of an early warning that our forecast may be too optimistic or too pessimistic. So, for example, let's say that we get into July and August, the tax cuts have landed and consumer sentiment has really bounced quite strongly. That'll tell me, okay, in advance of seeing the ABS data, I can be quite confident that we'll get that pickup in growth that we expect. And it tells me that the RBA easing cycle will be a relatively small and modest one. And if I think sort of forward to the end of this year and through 2025, we're only expecting 3 rate cuts in total from the RBA. Conversely, if we get through July and August and into September, and consumer confidence is still stubbornly stuck at the sorts of levels it's at right now, that gives me an early warning that actually, hold on, we may not, in fact, we're probably not going to get that lift in consumer spending, I expect. We're probably not going to get that lift in GDP growth. The economy will be weaker. There'll be a bit more downward pressure on inflation, and potentially it may not bring forward the RBA rate cuts, but it could flag that the RBA may need to do more than the 3 25 basis point rate cuts that we're expecting.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 30th. Catch you tomorrow with the details on key China PMI data later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.